We're joined by Weijian Shan, the Group Chairman and CEO of PAG, an investment firm that's based in Hong Kong. Weijian, thanks for joining us. You've been called by the FT one of the most successful deal makers in Asia.
I don't think they know better.
And recently you raised $2.5 billion for an Asia fund. What sectors are you looking at?
We have absolute return, we have real estate investment, we have about $9 billion under management, and private equity is part of it. We are very agnostic or general in our approach, but we do take what we call thematic approach to investing, which means we try to become experts in some particular sectors. And those would include consumer retail, food and beverage, healthcare, industrials and logistics, media, and so forth.
The private equity market in China has been growing quite fast with a lot of RMB funds. So how do you see the outlook for that market in terms of PE?
Given the fundamentals of the macroeconomy being so strong, and I would say most of our deals do come from China. I would say that you have different classes of investors. You have what you may call global funds, such as KKR, Carlyle, Blackstone, TPG. Then you have regional funds like ourselves and some other names who invest in Asia. For global funds, they invest all over the world. Then you have country-specific funds, RMB funds. RMB funds are very different from these international funds in that their term is typically much shorter, whereas we have a fund life of typically 10 years, plus one if you want to extend it. RMB funds typically would have a term of 4 or 5 years. Such being the case, it's very difficult for RMB funds to do so-called turnarounds and buyouts because it would take much longer. They simply don't have the life of the term of the fund to do so. And therefore, they mostly focus on pre-IPO investments. Now, when the market is up or going up, pre-IPO investments may be a very good strategy. If, like in the last 2 years, the market generally was going down, then pre-IPO became a not so good a strategy because the pre-IPO valuation may be higher than post-IPO valuation. If you're lucky, you could bring your company public. If you're not lucky, then you get stuck. So RMB funds, I think, were very active, and a lot of capital was raised in 2009 and 2010. But last year, it came down quite substantially.
There are concerns, though, about due diligence in China. How do you get around that?
Yes.
What's your approach?
China has many difficulties and challenges. I would say that China is one of the most difficult markets in Asia, for that matter, probably in the world. And due diligence, I think you mean that fraud is a problem, and that is true. And you would find that there's probably more than fair share of fraud. There's fraud in every country, but in China, I think there's more than fair share of fraud situations. And investors, if they're not very careful, would fall into. And that has many reasons that I would not be able to get into. But it means that you really have to look at every situation with grave doubts, and you have to assume that it is not true, especially if it looks too good to be true, and you have to check everything out. And there are many ways, and in fact, we internally would keep what we call fraud detection guidelines to enable us to look at different things in order to determine whether or not what you're told is true. For example, if they say steel production is certain metric tons, and you go to the Power Bureau to check their electricity bill, and if there's mismatch, you know that they're not telling the truth.
So what sort of things keep you awake at night? Is it the fact that you may not be getting full disclosure? You're dealing in large amounts of money.
If we make the investment, we are quite confident that we have checked out. But the major problem for China as a market is overcapacity. In the past 20 years, Chinese economy has grown by about 15 times. No other country at any time has grown so fast in history, right? In nominal terms. That translates into a GDP growth rate of about 14-15% per year in nominal terms. In real terms, still double digit, 10%. Now, if you had invested in Morgan Stanley China Enterprise Index 20 years ago, you have held your investment during this period of time, you would lose about 50% of your capital. No other country you will see this phenomenon. The reason is, whereas earnings have been increasing, the capital base with which you produce the earnings has been increasing faster, and therefore your ROE has been declining. And so a major problem for China is too much investments and therefore overcapacity.
What about frontier markets such as Myanmar?
When we do investment, we underwrite a deal. And the first thing that we underwrite is macroeconomic and macro conditions, not just economic, it's macro conditions, which means we look at, for example, the size of the market, we look at political stability, we look at if there's economic growth, and we look at if the monetary policy is stable, whether there's high inflation or stable prices, high interest rate or stable interest rate. We look at currency stability. So we will not invest in the market where some of these things are missing. And for example, if the size of the market is too small, then it's not conducive to buyouts. We invest, for example, no less than $100 million per deal. In a country like Myanmar, you'll be very hard pressed to find a business for you to invest $100 million. And in some countries, when the inflation rate is very high, the interest rate is not as high as the inflation rate, you would worry about devaluation of the currency and weak currency. So we have to think about macroeconomic conditions. Now, when you take all those things into consideration, you would find that today, China is more appealing and attractive to an investor because very large market. And in fact, the market has developed to such a stage that if one business model is successful in one province, you can quickly replicate it in other provinces as well. And steady economic growth, political stability, strong currency, and very low inflation rate, and very good public finances, right? Public finances are in very good shape, and that's why, that market by itself is quite appealing and attractive. In contrast, Japan is also a very large market in size, in terms of GDP, about the same as China, but it's not growing. And the public finance is in very weak condition. Their public debt is about 230% of GDP, whereas for China, it's 10% of that.
You've been speaking here at NUS Business School to a PE workshop, and you've been talking about Korea First Bank. You'll be talking about another bank that you're involved in.
Shenzen Development Bank.
Those have become Harvard case studies. What for you were the lessons from those?
Every case is different, and you, as an investor, we say you have to know what you're doing, which means you have to understand the business. But the most important part in our business is the process of creating value. And that means a lot is dependent on the management that you select. I think to have world-class management is probably priority number one. And if the management doesn't work out, you have to replace it.
But it also seems that you were trying to be fair.
Of course.
That was from a personal perspective.
Yes. When you do a deal, I always say that I adhere to one principle. That is, you have to be fair, reasonable, and logical. That is, it's not good enough that you say you're fair and reasonable. You have to be able to explain logically to the other side why it is fair. Because you have to look at the same deal from the other side, from the perspective of the other side. And then you can possibly figure out the deal that meets the requirements of both sides.
Weijian Shan, thanks a lot for joining us.
Thank you very much.